welcome all. This is Shivasagar S. Today we are going to discuss something about RBI's involvement in order to increase the transparency and standardization in lending rates of the banks. Of course, you all know there are two kinds of banks. One is scheduled bank, the other one is unscheduled banks. Okay. Of course, they are also have to abide by the lending rates which RBI prescribes. But when it comes to the history of RBI's involvement in fixing a lending rate, back then you had different kinds of lending rates. Initially we had prime lending rate, and the second one we had BPLR, benchmark prime lending rate, and thirdly we had base rate, and ultimately we have MCLR, and later on now we have RLLR, Repo linked lending rate. So that we are going to discuss at the end of the video. So when it comes to prime lending rate, back then in 1970s, no banks were having intervention from RBI in order to fix their interest rates. Mostly they were accordingly working with their discretion as well as independence. Okay, so they were supposed to fix the interest rate according to their discretion as well as their independence. They were independent and no RBI intention was there. RBI was not intervening or fixing any kind of interest rates that should be charged by commercial banks or any kinds of member banks and unscheduled banks when they are lending the loans to common people. It worked with the basis of discretion. Every banks accordingly to their cost of funds, the maintaining interest rate costs, and also they have to take into account the creditors risking factors like interest rates and different kinds of operating expenses. They were fixing the interest rate accordingly to their whim and fancies, deciding on the basis of their their cost of funds. Okay, so every customers will be getting a discriminative interest rates according to the leverage that they have, and no RBI intention was prevalent back then. The second one, RBI noticed that in prime lending rate there were a lot of issues, especially it was lacking transparency and standardization. RBI called all the member banks in order to fix a definite interest rate which would increase the transparency as well as standardization in banking system. Okay, so what did RBI do? RBI called all the banks. Okay, so they had a meeting, or let's say, of course, RBI typically has a meeting, monetary policy committee meeting every Sunday. Okay, so MPCC committee meetings are going to be happening every Wednesday, and to bring transparency and standardization, because PLR was facing all those issues because RBI was not regulating on monitoring all those interest rates. Okay, so every banks were independent and discretionary. The second thing which bank introduced by noting the issues of transparency and standardization, what was that was, it was lacking all those transparency and standardization. Banks were actually probing the problems that were prevalent in PLR, prime lending rate, and it wanted to intervene. It called all the banks, in order to make a meeting, and they came to a conclusion that every bank, accordingly to their size and accordingly to their operating expenses, what would be the ideal rate for banks to charge interest rate, that is should be minimum. At this minimum rate, it should not be below that minimum rate, but it should be a credible rate which the banks will charge for their trustworthy customers. Trustworthy customers who do not default any kinds of payments, who do not hold NPAs, they of course do their payments right, and also they loan, they'll get credited with higher amounts. So those customers were the targets, criterias in order to make this BPLR. It was introduced in the year 2003 it was introduced, and at this rate what was happening was they were considering the favorable minimum interest rate that should be charged to creditworthy customer. Every bank, according to their size and operating expense and cost of funds, they were fixing the BPLR, benchmark prime lending rates. this was followed by most of the housing banks finance corporation also. It was exclusively for, I mean, even BPLR is followed by current housing finance companies as well. Okay. So next factor was, even though this BPLR was implemented, 2009 RBI implemented one committee. The committee was working performance or group report on BPLR. Okay. So this committee was focusing on working performance group report on BPLR. In 2009, they found out most of the banks, out of their 77%, out of their total lending, 77% lending was reduced, lending was given at lesser than the BPLR rate. Previously, all banks were agreeing that they are going to lend the loan at lesser than, at equal to BPLR rate, but no banks were following because of the competition which they have. Okay, because the main aim of the bank is to maximize their profitability. In the verge of maximizing the profitability, banks tend to offer loans at a lower interest rate. This competitive behavior increased the banks to actually lend loans lesser than BPLR rate. Okay, so this was a problem. Again, the issue of lack of transparency and standardization was prevailing, and it was also infesting a lot, and it was disturbing the mindset of RBI. So RBI, what did it do? It again formed a committee and did a probing regarding the BPLR rate. In 2010, it introduced base rate. Okay, base rate was calculated with 4 factors: cost of funds, second one is minimum rate of return, third one is cost of maintaining CRR, cash reserve ratio. If fortnightly, if RBI is checking about cash reserve requirements, the banks, respective banks who are under RBI should also have this balance sheet which shows positive CRR or less than normal CRR. 2010, the base rate was introduced, of course taking the factors into consideration such as cost of funds, minimum rate of return which talks about the profitability, and of course cost of maintaining CRR, cash reserve ratio. Every bank is supposed to maintain cash reserve ratio in the form of cash. Okay, certain portion is being maintained, of course it's around 4% as of now, and you have operating expenses like the expenses which require to run the bank's salaries that are paid to the personals who are working in a bank. All those things are taken into consideration, but the base rate was on the basis of deposits. Of course, one of the primary functions of a commercial bank is to advance loans. Okay, advancing the loan is from the deposit that they have secured from the people. Okay, so here the drawbacks were, here they are only considering the base rate accordingly to the deposit basis. Okay, deposit basis which will never reflect a strong monetary transmission, because whatever the policies that RBI with the help of monetary policy is implementing, it is showcasing a what kind of trend? Weak monetary policy. Okay, so weak monetary policy transmission, weak monetary policy transmission. Whatever they are implementing in terms of monetary policy, the change seems to be slightly lower. So during 2015, I believe and they have reduced the repo rate around 1.6%, but 1.5 or 6%, or let's say I think approximately it was 1.25, but the transmission rate was 0.6. India being a good monetary policy country, even though the monetary transmission policy was weakened because of there is no effect on all kinds of interest and pricing part when it comes to this, because mostly repo rate means repurchase agreement, where commercial banks actually sell their securities and they are going to borrow the money from the RBI and they are going to purchase back the securities such as T-bills or different kinds of debt instruments which they are going to pledge with RBI in return of the loans. All those things will be repurchased at an agreed price. So whatever the money that they are borrowing in the form of repo rate, that is short term rate or long term repos or term repos, that should be serviced, and they were not considering all those things on the borrowing basis as well. They were only considering on the deposit basis, whatever the money collected by the banks from the customers in the form of deposits. On that basis, this base rate was forming. Because of that, there was no strong resonance in monetary policy transmission, because monetary policy transmission talks about how changes in one of the quantitative instrument or any kind of move made by RBI will reflect on the economic activity. That is, especially we are talking about interest rates as well as pricing stability. So that is why RBI again wanted to probe, because most of the banks who were using base rate, they were not actually doing this practice very well. The RBI was actually skeptical in order to find out the practicing part of base rate, because they are not showcasing the borrowing basis. Okay, so they were only making a rate only on the basis of deposit basis. So next, the one more thing which was introduced in order to remove the voids which were in base rate, they've added and they've updated few other things when compared to that of base rates. So the next lending rate was marginal cost of lending rates or marginal cost for lending rates. Here you typically all have seen banks borrow from RBI, banks actually get deposits from public, banks also borrow from their peers such as different commercial banks, banks also borrow from financial institutions. All are the sources with which bank will borrow the loans. And you know, call money, which you have seen in 1992 scam, and Lucky Bhaskar references, you can see banks borrowing from banks. If it is for 1 day, it is called as call money. If it is for 2 to 14 days, it is called as notice money. If it is more than 15 days, it's called interim money. So that is how banks actually borrow overnight basis or fortnightly or more than 15 days. It could be extending a month or a year. So banks borrow from different sources. So if it is from RBI, they have taken into consideration the repo rates and tenor in the sense the time to service all those repo rates, servicing cost such as paying the interest rates every monthly or every fortnightly, depending upon the type of loan or the term of loans that they have borrowed from RBI or from different kinds of commercial banks that they are going to, they have been borrowing. So initially when we speak about cost of funds, we only talk about the interest rate or the servicing cost, which withholds the internal cost of a bank, also talks about the profitability it should earn. So on that basis they were thinking, but it was merely restricted to deposit. But here what has happened here is, okay, so you can see that RBI's intervention was examining a whole lot of things. It was on the basis of both deposits and both borrowing, both deposits and both borrowing, deposits from the common public and borrowing from the RBI banks repo rates. Okay, so because RBI also gives you gives the loans for commercial banks overnight basis as well as sometimes 14 days repo rates. Okay, so those are short term borrowings within a year. Long term borrowings are called bank rates more than 1 year. Okay, so I have spoken about it. Repo rates consist of term repos and long term repos, and more than 14 days it is term repos. If it is closer to 1 year, that is long term repo rate, and it could be more than 1 year also in some cases. So here both the things were taken into consideration on the borrowing basis. Okay, so here both the things were taken into consideration, focusing on marginal cost of funds. Okay, so in addition to that, previously while calculating base rate, we had minimum rate of return, which talks about an internal rate of return or a profitability of bank. So it withholds all those credit risking abilities and different kinds of evaluation methods in order to gain assets or get profit out of the assets. Okay, bank typically has two kinds of balance sheet. One kind of balance sheet in which it has assets and it also has liabilities. Liabilities in the sense what bank owes to the public as well as other banks or different kinds of financial institution. Assets are those which it owns. With the asset which it has, it also needs to calculate the expected profitability. So minimum rate of return, okay, internal rate of return that I've talked about, cost of maintaining CRR. Sometimes banks may go with negative CRR. To maintain those costs, banks typically have to borrow from other banks, or somehow it should fill that gap in order to show CRR in positive numbers or at a balanced number. And operating expenses to the bank, and of course what are the operating expenses? It has to pay salaries, it has to manage the entire bank. Those servicing cost in terms of administering the bank and operating the bank will be your operating expenses to run the bank, and all those things were taken into consideration here. MCLR of course was having a small drawback here. Even though it wanted to bring transparency, I'll mention transparency with T and standardization with S, there was lacking effectiveness, because even though they've taken into consideration repo rate which affects the bank's liquidity, the problem was they were only thinking about internal cost of funds. They were not talking about external cost of funds. Because of that, there was a slight increase in monetary transmission. We had a little bit stronger monetary transmission compared to that of base rate which we were following back then in 2010, from 2010 to 2016, 2016 March 30. So this MCLR was implemented after April 1, 2016. Despite of all those things, banks faced a slower monetary transmission rate. In order to remove this problem, again banks, RBI intervened, and in order to remove the problems in MCLR, RBI came up with repo linked lending rate. Repo linked lending rate, RLLR. Okay, repo linked lending rate, repo linked lending rate. It was introduced by RBI. So what does this talk about? It talks about the MCLR conventionally talks about internal cost of funds, but RLLR talks about external mechanism of repo rate. Okay, so any loan that is going to be provided by banks should be following RLLR, which changes right away when RBI changes repo rate. Okay, short term borrowing, RBI's repo rate is nothing but short term borrowing which banks can avail for 1 to 14 days. If it is term repos, it is more than 14 days. If it is repo rate, it is a overnight borrowing to a fortnightly borrowing, 1 to 14 days. So any customer who is going to avail a loan will be availing the loans on the basis of RLLR. It talks about the formula for RLLR is repo rate plus spread. Repo linked lending rates formula is repo rate plus spread. Spread talks about the managing cost of a bank when they are actually paying the interest rate for deposit, plus spread talks about profitability. Okay, so managing cost of the deposits, or let's say servicing cost of the deposits which a bank actually pays interest to the commercial banks, to the commercial bank customers, plus whatever the expected profitability they are going to earn, that will be taken into consideration while implementing the RLLR. Okay, so this happens here. Suppose a person who is going to avail a housing loan, he will be charged with 6% that of repo rate plus 2.5% that is the spread in the sense extra profit. Okay, after deducting all the liabilities with the expected revenue, you will get this spread it will talk about the expected profitability of a bank where they may maximize their internal rate of returns. Okay, even the MCLR talks about repo rate. Here they are only considering internal cost of funds. Here they are considering external cost of funds. Okay, so the monetary transmission rate is faster than MCLR. In RLLR, the monetary transmission rate is much faster than what happens in what is that, MCLR, marginal cost lending rates. Okay, because periodical changes will also happen. In RLLR, every 3 months the periodic set happens. If RBI reduces the RLLR, what happens is the customers will also get benefit. And if RBI increases its monetary policy, like it is being it is using a contractionary monetary policy, especially it is making changes in repo rate. By increasing the repo rates, it will automatically be cumbersome. The austerity measure of this contractionary policy with regards to repo rate, I mean increasing in the repo rates, will also burden the customers when they are paying it, because every quarterly there might be a chances of repo rate being changed, either increasing or it might be decreasing. Okay, so but in marginal cost of funds, the transmission rate is slower, because every changes in the internal cost of funds is for 6 months to 12 months. Okay, so this is how the bank rates have evolved. Initially it was PLR, prime lending rate. Banks had independence and discretion to levy, I mean to actually incur interest rate, I mean to fix an interest rate according to their whim and fancies. Whim and fancies in the sense I am talking about operating cost of banks and accordingly to the customers which they have. And later on BPLR was the benchmark prime lending rate, which talked about RBI intervening there and fixing the interest rate per the respective creditworthy customer of every bank. And it did not bring transparency and standardization, because banks were following preferential interest rates. They were giving loans lesser than BPLR. And again the working group committee on BPLR showed the findings. 77% of total lending of a particular bank, of all banks particularly, were charging the interest rate lesser than BPLR. Later on base rate came. Base rate were also having flaws. They were calculating the interest rates, lending rates only on the basis of deposit basis, that is only focusing on the consumer deposits. It is not focusing the borrowing basis. Later on MCLR came up with the borrowing basis as well as deposit basis. It included tenor premium, the time premium, servicing debt, and all the other factors which are included in base rate, tenor premium and marginal cost, that is related to repo rate. But here they are only talking about internal cost of funds. Later on we had RLLR, so repo linked lending rate. Okay, so here repo rates are being used as an external mechanism. Whatever the changes that are happening in repo rate will be right away reflected in RLLR. Okay, so here the monetary transmission rate is stronger compared to that of MCLR. Previously all those rates have a weak monetary transmission rate, okay, which I have said an example initially. Okay, 1.6% changes in repo rate have affected the entire economic variables, with 0.6 having a weaker monetary policy transmission. Okay, so these are the important bank lending rates which have shown an impact in Indian economy, and these are the changes which have taken place. Now these are some important things that you have to remember in your examination. Thanks for watching, and stay connected with our channel. Thank you.